If a stock is going to have bad earnings, should you sell it? What if the expectation is that it's going to have bad earnings? Then how does that change? What if you expect that other people expect that it is going to have bad earnings, but in fact it won't? How does that change your analysis? And if this is already getting confusing, that is because this is the difference between level 1 and level 2 thinking. If you think about NVIDIA, many people believe NVIDIA is going to continue to dominate in GPUs and be a huge AI beneficiary for many, many years to come. That is level 1 thinking. Level 2 thinking says, is it priced in? The fact that everyone else already thinks that this is going to happen means that when you buy the stock today, is that already embedded in the price? Because if you remember, when you buy a stock, the price you're paying is supposed to be the sum of all discounted cash flows back to today. So that includes all expectations of what is going to happen in the future. And so NVIDIA doesn't actually have to be dominant for 20 years in order for that to already be priced into the stock. That is a key thing that investors miss all the time. Because just because you're right about the business doesn't mean you're going to be right about the stock, because other people could have already seen the things that you have seen. Now, the way you test for this, though, is you have to back into the assumptions you need to make in order to get the stock to show a return that is acceptable to you. And so, just generally speaking, stocks have returned 9%, for the past 100 years. That is roughly what they have returned. So we're just going to say that if a stock is expected to earn 9%, then we are going to say that it is already pricing in these outcomes. Okay, how do we do the math on what needs to happen in order to get a 9% return? Simple. We just make some assumptions. Now, in the case of NVIDIA, they have roughly $140 billion in revenues they're expected to have this year. And their market cap is $4.5 trillion. And so what is the market at a $4.5 trillion valuation expecting them to do in the future? You can just make some simple assumptions. Over time, stocks have traded around about 18 times multiples on average. That means once they are done in these sort of hyper growth phases, they all tend to come back and trade on average around 18 times. Now, if it is truly done growing, you probably want to actually put a 10 times multiple on that. But let's just take 18 times. And so what you can do is you start with this market cap of $4.5 trillion and you start layering in these assumptions to see what is currently priced into the stock. And so, if you think about a PE multiple, that is a price to earnings multiple, we're basically just going to flip that equation and try to get what earnings need to be in the future to rationalize the existing valuation. So start with $4.5 trillion for NVIDIA. If it trades at 18 times, that's going to get us our earnings figure. We're going to assume it has a 40% profit margin. That's going to get us our operating income figure. We're going to assume it has a 20% tax rate. That's going to get us our pre-tax earnings. Then we're going to assume a 40% margin. That's going to get us our operating earnings. And then we divide by that 40% margin and we get revenue. And if you do that math, let's say 18 times multiple, 40% margin, 20% tax, you see that NVIDIA needs to make at least $780 billion in revenue at some point in the future in order to sustain that existing valuation, if we're going to assume that 18 times earnings multiple. Now, here is the tricky part that people miss. That doesn't mean that you believe they're going to grow from 140 to 780. You believe they're going to do at least that, because that is what is currently being priced in. And so if you want to make an investment, you want to believe they're going to do even better than that. They could do even better than that because you think the operating margin will be higher. You think revenues will be much higher than that. Or perhaps you think that it's going to trade at a high multiple forever. Of course, though, if you are picking a higher multiple, then what you're basically saying is that you do expect higher growth for even longer into the future. And so that is just one simple way of looking at it and thinking what is priced in. And so when a bad thing happens to a stock and you see it as down a lot, it's very possible that it's very quickly already being priced into the stock. And so now whether or not you should sell because you think a growth rate is going to be a little bit lower, it's going to be trickier now because it's already priced in. And that is something you have to always think about when you're investing, because the market does have a lot of people that are constantly analyzing these businesses and buying into them and selling them. And the question is, what is priced in? Now, you could actually do this in an even more precise manner doing the reverse DCF. Now, this gets a little technical and it may be a little easier if you read the memo below in the show notes link that talks about a reverse DCF and how to do it, because it has more pictures and graphics. Still learning how to put that all into the videos. I know that's something everyone wants to see. I want to do it as well. We're working on that. But just in the meantime, I'll walk you through it. Reverse DCF is basically, instead of putting in a discount rate and solving for the price you're going to pay, you start with what the current price of the stock is and you make that equal to, the price you would have paid, your valuation. And then it solves for a discount rate. The discount rate is the output. And you can do this in Excel if you just do a what if analysis. That's kind of the easy way to do that. And you set up your DCF the same way, except instead of your output being a valuation or a stock price, you start with the stock price. And now your output is going to be the discount rate. And when that discount rate equals that sort of 9% we talked about, you could say that's roughly what is being priced in. Now, of course, you could take your own opinion about that rate and all that. That's a whole nother can of worms I don't want to open up right now. But you can basically vary your revenue growth assumptions, your profit margin assumptions until it does hit that 9% and you can get an idea of what is being priced in. Now, if you want a shortcut to doing that, you could just do kind of the way we laid it out with the assumptions. That is a way you could kind of get there a lot quicker. And so I hope this kind of gave you a little bit to think about. I do want to come back to this topic and more in depth with more on the reverse DCF, more on how to exactly calculate what is priced in with more examples. But in the meantime, make sure you hit subscribe so you get alerted and are there when that video does come out and we talk much more about this in the future.